Welcome to OptionTiger.com. My name is Harry Swaminathan. In this series, we are going to look at the Iron Condor strategy in detail. There'll be multiple videos on the Iron Condor. The Iron Condor is a very popular strategy, and it's very popular for a reason. Some of the greatest things about the Iron Condor is that it's non-directional, and you also get to keep double the premium. So let me show you what I mean. So we're looking at the SPX, which is the S&P 500 index itself. And what you want to do in an Iron Condor, the Iron Condor is primarily a time decay strategy. So, which means you take the position, and let me shut this down here. You take a position, and then you take advantage of time decay. So what's the ideal number of days left to expiry that you can choose? So here you can see the May series has 16 days and the June series has 51 days. So I would say the ideal may be about 45 to 50 days. So the June fits our requirement fairly well. And what you want to do is the market is right here. It's at 1592. So at the money options are between 1590 and 1595. So what you want to do when you want to put an Iron Condor is you want to give yourself probability. So here we see we have 20 strikes. Let me increase that to about 40 strikes. And so when we say probability, you want to go to about a 15 delta. Now you could go to 20 delta, you could go to 15 delta, you could go to 10 delta also. I'm just taking the midpoint there at about a 15 delta. If you see, the S&P is at 1593 right now, and a 15 delta is at the 1495. So that's a lot of room on the downside. So similarly, what you want to do is on the upside, you want to go to approximately a 15 delta on the upside. So which would be around say 1655. Now you can see there's a big difference between prices on the call side and prices on the put side for the same delta. So, which means what you can do is to come a little closer on the call side. So, instead of going out to 15 delta, you could potentially come to about a 20 delta, which would be at the 1645 level. And you create the Iron Condor. So, the Iron Condor is a combination of a bull put spread and a bear call spread. So, let's go ahead and put the bull put spread, and you would be selling a vertical. And let's say you sold the 1495 to 1490 spread, you're going to get a 65-cent credit. And then if you come to the call side, and let's say we said 1645, so let's sell a vertical spread here. And you can actually put it as one trade also. But let's say we did this, and you can see you're getting a little bit of more credit. So if you wanted to be somewhat safer, you can go out to the 1650. This would be the short strikes would be on the call side would be approximately about 17 or 18 delta. In fact, you can see it right here. It's 17 delta. So this is good. So now you're getting double the credit, but you see your margin has actually reduced because of the other position. So if I take this off, you can see your margin is going to go up. But when we add this other bear call spread, your margin actually comes down. So you're getting about $1.50 in credit. If you go look at the risk profile, this is what it looks like. And it seems like we've got way too much room on the downside and not enough room on the upside. But you have to bear in mind where the S&P is right now. Today is April 29th or April 30th. And we are looking at the S&P at an all-time high level. So it may be prudent to give yourself more room on the downside, because just statistically speaking, you can expect the market to turn around a little bit and come somewhere here. You could do that, or you could increase, you could bring this at the 1500 level and bring this to 1495, and that might make a little difference. Again, it's not going to be a whole lot, but this is this is better. So here you're getting $1.45 credit. So that'll be your max profit. Your max profit is going to be for 10 contracts. It's going to be 1450. You can see the red number here. That is going to be the maximum profit. And your margin or your risk is 3,550. So in general, when you put an Iron Condor, you're going to see that your reward is much less than your risk. And why is that? And that's because you're putting probability on your side. So what you're really saying with this strategy is that as long as the S&P 500 doesn't go up to 1650 or doesn't go fall down below 1500, we are going to be making our maximum profit. So this is a probability play, and in with options you can do this. And if you're familiar with a bear call spread and a bull put spread, which you should be if you're trading an Iron Condor, then you know what this means. You're putting a lot of probability on your side, and that's why your reward is going to be much less than your risk. So this is what the Iron Condor could be structured as. Now, what we're going to do in future videos is going to tackle this strategy, and I'll show you various variations. When do you adjust the Iron Condor? How do you choose the strikes? And what kind of adjustments are possible, and all that good stuff. So subscribe to this playlist and subscribe to our channel here, and you'll be immediately notified. You'll be automatically notified of any new videos that are added to our channel. So go ahead and hit the subscribe button, and we'll see you on the other videos. Thanks.